In this video, we're going to talk about depletion, which is basically a method of depreciating natural resources. And natural resources, when we think of financial accounting, we sometimes think of them as a wasting asset. And we say wasting in the sense that natural resources don't just lose value over time, similar to, let's say, a piece of equipment that we think of depreciation. We just say, okay, we'll use straight line depreciation over 5 years, it'll lose value. With depletion, with natural resources, we're thinking that the asset is wasting away as we extract gold or silver or timber or whatever resource that it is that we're talking about. It's kind of wasting as we extract it. So we have a little bit different method for calculating or spreading this cost over the useful life of a mine or whatever it is that's being depleted. And we're going to talk about that here in this video. But first things first, we need to be able to calculate something called the depletion base. The depletion base, which we're basically trying to figure out what is the cost that we're going to be spreading over the life of this asset here. So basically, with a piece of equipment, you might think, well, it's $100 to buy this machine, and that's my cost, that's what I need to allocate. But with depletion, we've actually got multiple different things going on, and one thing is acquisition cost. And the acquisition cost is basically the price paid to obtain the resources, to the price paid for some kind of lease, to lease the mine. Those types of things we think of as acquisition costs. And then we also have exploration costs. And exploration costs is like, okay, now that you have a mine, you might have to figure, okay, what part of the mine has the assets. Basically, you don't just automatically have gold and silver. You have to do some exploring. For example, if we're talking about oil, and you purchase this huge tract of land or access to, this huge tract of water, you have to figure out, okay, well, where is it that we're going to drill? Where is the oil? So you have to do some exploration. And sometimes these costs, these exploration costs, are not necessarily going to be part of this depletion base. That is basically what we're trying to figure out here. So exploration costs, sometimes, for example, with oil, in some cases, it'll just be immediately expensed. So it could be expensed or it could be capitalized. It depends on the type of natural resource or what the firm chooses to do. So it could or could not be part of this depletion base that we're trying to figure out. So a third type of cost that's going to go into the depletion base, and this is often a large cost, is the development cost. Now, development is, okay, now we've acquired the land or the lease, or we've got some mine or some tract of water, or we've explored, now we know where we think the resource is, but now we have to go and we have to start incurring costs to extract it. We have to develop this mine. We have to build things like tunnels and so forth, or an oil rig, and these can be tangible. And for example, the example I just gave, an oil rig drilling platform, that's a tangible asset, right? You can touch an oil rig. Let me just scroll down. But you could also have intangible, right? I mean, like for example, this tunnel to get some coal. Now, technically, I guess you could touch a tunnel. You can be inside a tunnel, but it's not really a tangible asset in the same way an oil rig is. So we can think of something like a tunnel, a well that's built, the actual drilling itself, right? It costs money to actually do the drilling, and that's not really a tangible. That's not something you touch. So those are all development costs. Now, the tangible aspect, when we think of a machine or something that's used to extract resources, that could just be depreciated on its own. So that is not necessarily part of depletion base. So this, again, we've got this thing where it's not like the exploration where we're talking about just expensing the cost immediately or capitalizing it. Here we're going to depreciate the machine, but it would just be separate. It might not necessarily be part of the depletion base that we're going to be depleting and having expense for. So, but intangibles, when we think about the intangible development costs, that's almost always going to be part of this depletion base. So just bear in mind that. And then also we're going to have, let me change colors here, we're going to have restoration costs. And this is basically when we're done with the piece of property, we might have to restore it to its original condition. And in some cases, you'll hear that referred to as something called an ARO, or an asset retirement obligation. So we basically have to put the land or put the water back in order. We have to, well, that sounds kind of silly, putting something in order, but I mean, maybe clean it is a better way of thinking about it. We have to clean up the site and do some things when we're done with this mine or with the area where we're drilling. So we have to incur some costs with that, and that becomes part of our depletion base. So all four of these different things can be part of the depletion base. And in case of like acquisition costs, they're definitely going to be part of the depletion base. And so let's work through an example. Let's say that we buy a mine. So let's see here. Example, we buy a mine because we want to extract some type of ore. Well, it could be iron ore, but let's not get into the specifics, but let's think about the cost that we have. So let's say that we have to pay for a lease for the land that the mine is on, and that lease, we're talking $100,000. And then the exploration costs, that's finding what part of the mine has the ore that we want to get. Let's say that costs $150,000. And then the development, so now we've got to actually go and build the tunnels. We've got to get the machines in here and actually get that ore out. That's going to cost $750,000. And then let's say the restoration costs, there are none. There's nothing. And in this case, the lease would be like part of the acquisition costs. And so now we've got our four main types of costs here, and the total here, and this is going to be our depletion base that we were talking about calculating, is $1 million. And now we've got to, just like assets that we depreciate, we've got to think of a salvage value or residual value. And let's just say that that's zero. There is no residual value here. Now what we have to do, we've got to get our geologists together, and we got to figure out an estimate. So estimate of the amount of recoverable units of ore. How much ore do we expect to get? Estimate recoverable units. And so let's just say that we talk to the geologists, and they think that there's 500,000 tons of ore inside that mine. Oh, ore, not an I. So now what do? Well, we've got this nice formula for calculating depletion. So we can just go. So here's our cost depletion, which is the method we're going to be using. So cost depletion, think of the total cost minus any salvage value, I'll just abbreviate that, and then divided by the total estimated recoverable units. So estimate recoverable, the estimated recoverable units. Okay, so in this case, the cost depletion, what we're going to have, our total cost is $1 million. The salvage value is 0. And then the estimated number of units, well, that's that 500,000 tons of ore. So let's just plug these numbers in. This is the part that's pretty straightforward. So we're going to have 1 million. Let me have a comma there. 1 million minus 0, no salvage value, divided by 500,000 tons. And if you break out the calculator, you can see that comes out to $2 a ton. $2 a ton. So for each ton of ore, we're going to attach $2 of depletion to it. Now that'll make a little more sense as we actually go and recover some ore. So let's go and let's say that in year 1, let me just kind of separate this out. I know it's a lot of information, just bear with me. So year 1, the first year we have this mine, we go and we recover, or we obtain, we extract 50,000 tons of ore. 50,000 tons of ore. Now what do? How do we make the journal entries? Well, so we're going to have depletion. It's good, $2 a ton. So what do? We take that $2 and multiply it by that 50,000. And that's going to give us 100,000. Right? So we're going to have, now what do we do with this? Well, we're actually going to debit inventory. Right? Because now this ore is in our inventory. Right? We can sell it. That's the whole reason we mined it. So we've got inventory of 100,000. And then this account, we're going to credit accumulated depletion. Accumulated depletion is our corresponding credit, and that's going to be 100,000. And again, that 100,000 is just this $2 a ton, and we recovered 50,000 tons, so there's 100,000 in depletion. Now, you might be saying, okay, well, how does this end up as an expense? Because we're supposed to be spreading this $1 million over the life of this asset, this mine. All these costs that we capitalized, we need to be expensing them. Well, let's say now that we go and we sell all this inventory. Now, this is where it's going to be reflected, the expense, where we're going to have our income statement effect. So now we sell all, let's say just we unload all 50,000 tons. So part of this journal entry is going to be cost of goods sold. Right? We're going to debit that for 100,000. And then we're going to credit inventory to reflect that we no longer have the 50,000 tons of ore. Now again, this is when we sell this that we make the journal entry, not when we recover it. This is the entry when we recover the ore. Now this is on, let's say, sale of 50,000 tons. Now, of course, we're going to have another journal entry as well where we're going to have a credit to sales and so forth. But right now, we're not thinking so much about all that. We don't want to get into putting together an entire income statement. We just want to see how does the expense, how does that cost of that million, and now we've got 100,000 of it has been depleted. How does that affect the income statement? And it's right here through cost of goods sold. Now you could also think about this as depletion expense. If that's a little more intuitive for you. And so that's our depletion expense. Basically, we have depleted that asset. Now let's go to our balance sheet for a moment here, a mini balance sheet. We've got our asset, we've got our mine here. Now remember, we capitalized it at $1 million. $1 million, but now it's been depleted for 100,000. That's that accumulated depletion. I'm just going to abbreviate here. So that's accumulated depletion. So now that asset is at 900,000. And then we recorded the inventory, but then we ended up selling the inventory. So that inventory is back at zero. And so what do we have with the mine? Well, we're basically reflecting that, hey, we took a lot of resources out of that mine. We took all the resources out of the mine, so we have to reflect that the mine is not, it's been depleted. It doesn't have the same value that it has when we originally obtained it. So we're basically just spreading the cost with this accumulated depletion. We're spreading the original cost, that $1 million that we pumped into this mine, and we're spreading it as we extract the ore from the mine. So we're just kind of spreading the cost of that $1 million, and based on the amount of ore that we extracted and our depletion rate and everything that we calculated in this period, we had 100,000 of accumulated depletion, and then that flows through and affects the balance sheet directly, and then the income statement once we get rid of the inventory. And again, it just goes right through cost of goods sold, or if it's easier for you to think about it, that's our depletion